Welcome everyone to this webinar. We're going to give it just a few more moments here in case anyone is hopping in to join us today. I'm excited to share this topic with all of you, specifically as we talk about what first-time home buyers should know. My name is Josh. I am excited to be your host today, and we will start in just another few moments here. Alrighty then. So today's topics include, we're going to, of course, outline some different first-time homebuyer programs that are available to you when you are looking at purchasing your first home, which is an exciting moment to have. We're also going to briefly outline the home buying process, and then there will also be a time for questions and answers. You should see a box for questions and answers in your webinar screen. There's also a chat which you can use as well. Feel free to, as I'm going through and presenting all of this information, if you think of any questions, to drop those in that question and answer box. And then at the end, we will go through those and make sure that we help address anything along the way that I maybe wasn't very clear on, or if there is additional information that you would like to know about some of these programs. Few disclaimers that I would like to go over is that these programs are intended for a primary residence, which is defined as a buyer who intends to live in the residence for a minimum of 6 months. And a first-time home buyer is defined as anyone who has not owned a home in the past 3 years. So if you owned a home 4 years ago and you sold it, you moved into an apartment or you moved in with some family, and now you're looking at buying a house, if you have not owned a home in the past 3 years, then you would qualify as a first-time home buyer. These programs are available in Pennsylvania, North Carolina, Florida, Texas, Virginia, Maryland, Ohio, which are all states that Collab Lending is licensed and operating in. These programs are not available in our Puerto Rico market, unfortunately. So please reach out for questions about becoming a first-time home buyer in Puerto Rico. We will be covering major loan programs today, conventional, which includes Fannie Mae and Freddie Mac, as well as some government loan programs, such as the U.S. Department of Agriculture, the Federal Housing Association, and the Veteran Affairs Program. Some things that lenders are going to look at is topics such as your credit, which is your ability to repay money borrowed. As you may know, each of us is given a credit score, which is a grade, if you will, of how well we have repaid money borrowed, whether we made those payments on time, whether we had excessive obligations. Those all give us a credit score. And that credit score is actually what determines the financial terms and the program eligibility for buying a home. So the credit score is going to largely impact you in ways you may not expect. It's going to determine if you have a great credit score, you'll have a lot of loan programs available to you, as well as the best financing possible. If you have a poor credit score, then you'll have limited options available to you, and the terms will not be as competitive as other loan programs could offer you. Lenders also look at your income, which is your ability to produce income to repay the loan. Specifically, they want to look at the last 2 years of work history. They're also going to look at your assets, which is, do you have the funds available for a down payment and/or closing costs? And then lastly, they're going to look at the subject property to determine if the property qualifies as collateral, because the loan on the mortgage is going to be secured by the home that you're purchasing. Now, let's start off with conventional loans. Fannie Mae and Freddie Mac are both some names you may have heard of once or twice in your life. Fannie Mae was first chartered by the US government in 1938 to ensure a reliable and affordable supply of mortgage funds. Freddie Mac was chartered by the US government in 1970 to support the US housing finance system and also to ensure a reliable and affordable supply of mortgage funds. Both Fannie Mae and Freddie Mac provide the funds and guidelines for mortgage lending. So when banks or lenders provide the funds to you as the borrower, those are coming from Fannie Mae and Freddie Mac. And so when we also talk about what you can and cannot do for a mortgage, again, that goes back to these guidelines that Fannie Mae and Freddie Mac have issued. Fannie Mae's guidelines specifically are over 1,000 pages long. They are, it is a dense document that has a lot of ins and outs, which is where we as your mortgage experts come in because we have spent time studying those guidelines and we know and are familiar with them. Both Fannie Mae and Freddie Mac have first-time homebuyer programs. The first of which I want to address is the Home Ready and Home Possible loan programs. Home Ready is the Fannie Mae version. Home Possible is the Freddie Mac version. One of the key features for Home Ready and Home Possible is that it requires a 3% down payment, which is based on the purchase price. For instance, if you're buying a house that costs $100,000, with Home Ready and Home Possible, you will be required to put a minimum down payment of $3,000 down. Both of these programs require a minimum credit score of 620. Another key feature for Home Ready and Home Possible is that you have a lower variable rate of what's called private mortgage insurance, which is PMI. PMI is a feature that comes with most loan programs. It is insurance that is paid for as part of your monthly payment that helps if the mortgage should ever go into default, if you can't make the payments on time, essentially. If you've ever heard of someone like a parent or someone tell you that you should wait to buy a house until you have 20% to put down, that is because they are telling you to put that larger down payment down so that you can avoid paying PMI. But if you don't have 20% to put down, most of us don't have a large chunk of money lying around to buy our first house with, that is where lenders offer this private mortgage insurance as a security blanket, if you will. So with Home Ready and Home Possible, you get a lower rate of private mortgage insurance than you would with a standard conventional loan. Now, you can also get up to 3% in seller's assistance if offered for closing costs. And again, going back to that $100,000 example, the seller could choose to take $3,000 less from the sale of their home and to provide that to you as the buyer to help with your closing costs. Now, Home Ready and Home Possible do have maximum loan amounts for a 1 unit of $726,200, which is to say that that is the maximum amount of money that you can borrow with a conventional loan. Now, if you're buying a 2-unit, a 3-unit, or a 4-unit as a primary, which you can do, they do have different down payment requirements and different loan amounts as well. Now, with Home Ready and Home Possible, you do have to qualify specifically from an income standpoint. There are income limits which include 80% of the area median income as the threshold. So if the area median income is $100,000 and you make $72,000 in annual income, that is less than 80% of the area median income, you would qualify for these programs. If, however, you make $93,000 in annual income and the area median income is $100,000, you are above that 80% threshold, and then you would not qualify for this specific program, but there are some other programs where you would qualify. Home Ready and Home Possible both require the borrower to complete an approved home buying course, which you can do online. So you have a little bit of homework that you're doing. These courses typically take an hour or two. You can complete them online during the day, on weekends, but they would have to be completed prior to you closing on the home. And it basically provides additional information to help you as you're becoming a homeowner for the first time. Now, Fannie Mae and Freddie Mac have additional home ownership programs for first-time home buyers called the Fannie Mae 97 and the Freddie Mac Home 1. These are very similar to the Home Ready and Home Possible programs that I've already outlined. The difference is 2 exceptions. First, you have standard variable private mortgage insurance. You don't get that discount for the private PMI that you have with Home Ready and Home Possible, but you also don't have the income cap of 80% of the area median income that you also have with Home Ready and Home Possible. So if you make too much money to qualify for Home Ready and Home Possible, you can still use Fannie Mae 97 and Freddie Mac Home 1 to make a 3% down payment and still purchase your home with a conventional loan. Next, I'd like to talk about the U.S. Department of Agriculture. This was created in 1991 to help expand access to mortgage financing in rural areas. This program is often mistaken for a farm loan, which is a separate loan category. One of the key features for a USDA loan, give me a second here, I'm trying to advance the slide. There we go, is no minimum down payment is required. Now that is big for any borrower who is struggling to get the assets, specifically the money needed for the down payment and closing costs. USDA comes along and says you don't have to put a down payment down when purchasing the house. You would still have closing costs. The minimum credit score for USDA is 620, but you can be eligible to receive up to 6% in seller's assistance if offered for closing costs. Now, a borrower, a actual team member of ours here at Code Lab, bought a house several years ago, and he used a USDA loan, which did not require a down payment, and he received maximum seller's assistance. And he only had to pay for his appraisal out of pocket. He didn't have to bring any funds to closing because the seller's assistance covered his closing costs on the house that he was purchasing. Now, that was a perfect storm of a scenario for him. I would say most USDA loans do not work out quite that picture perfect, but I highlight that as an example to say that with no minimum down payment required, and if you can also receive seller's assistance, it can make it very affordable to purchase a house with this program because of those factors that come into play. So you could buy it with only having a little bit of money in savings as opposed to a lot of money in savings. USDA does have the lowest fixed mortgage insurance of any of the programs, and the maximum loan amount does vary by the county. Specifically, typically you're looking at loan amounts of $400,000 or less with this program. Now, USDA is restricted by population density. So you could Google USDA property eligibility, and the first link that comes up when you click on that, if you click accept or I agree, it comes up with a map and a search box where you can type in addresses, and you can see if the address of a house you're looking at is in a USDA eligible area. Like Home Ready and Home Possible, you do have to be within that income limit of 80% of the area median income. USDA also has the tightest lending restrictions as far as the lowest debt to income ratio allowed. And homes have to meet HUD guidelines, which is the housing of urban development. Some common issues with homes that have to be addressed with USDA before you can close is if there's any chipped paint on the inside or outside, if there's any missing handrails on the front porch or any stairs, if there's any exposed electrical, such as missing outlet covers or light switch covers. Those are all things that would have to be addressed with a USDA home purchase that could generally be ignored more than likely with a conventional home loan. So these are the trade-offs with a USDA program. But again, this can be a great program for first-time home buyers if they are struggling to build up the assets and the savings to cover the down payment and closing costs for a home. Next, I would like to talk about the Federal Housing Administration. This was first established in 1934 to help facilitate home financing. It is often mistaken as a first-time home buyer loan. And while it can be ideal for first-time home buyers given the right circumstances, it is not limited to first-time home buyers. This program is more forgiving to borrowers regarding credit history, as it allows for lower credit scores, and it is more forgiving in terms of credit events like a bankruptcy. If, for instance, you declared a Chapter 7 bankruptcy, with a conventional loan, you can't receive lending until you are 4 years after that bankruptcy. With USDA, it is 3 years after that bankruptcy, but with FHA, it is 2 years after that bankruptcy. The FHA loan program can also be used repeatedly as long as the borrower does not have more than one FHA mortgage out at a time, which is another myth that I have found among buyers. The FHA has a minimum credit score of 500. I will say that if you have a credit score of 502, you're going to need some compensating factors to offset your credit risk. What I mean by compensating factors are having significant income, having a larger down payment, having significant savings, which can also be used to help make your mortgage payment. If you have a credit score above 580, you're looking at a minimum down payment of 3.5%. If your credit score is below 580, you're looking at a minimum credit score or a minimum down payment, excuse me, of 10%. Now, I've been working on a borrower this morning, actually, who has a deciding credit score around 556, I believe. And they're putting a 20% down payment, and they also have significant savings, which act as compensating factors that allowed them to get pre-approved for an FHA mortgage where they would have been denied by other banks and lenders. FHA, like USDA, does allow you to receive up to 6% in seller's assistance if offered for closing costs. It does allow for a higher debt to income ratio than conventional or USDA. So FHA can sometimes provide buyers with more purchasing power, in that you can purchase something that costs more with an FHA loan than you can with conventional. And the max loan amount for a 1 unit with FHA is currently $472,030, which is to say that's the maximum amount of money that you can borrow with an FHA loan. FHA does have fixed private mortgage insurance like USDA. It can be more affordable or more expensive than conventional depending on where your credit score is at. If your credit score is in the 500s or the 600s, the private mortgage insurance is going to be cheaper than it would be if you buy with a conventional loan. If your credit score is above 700, for instance, that PMI is going to cost more with an FHA loan than it would with conventional. And that's because with FHA, it is at a fixed rate, it's a fixed percentage. Whereas with conventional, it varies based on your credit score and can be lower or higher. With FHA, inspections are only required if they are elected on the contract. And this is another myth that I often find when I speak with realtors. Realtors and listing agents often don't like to accept FHA offers because when they hear FHA, they think, oh boy, we got to go through all these extra hoops and go through all these extra inspections before the buyer can close on the home. And that's not always the case. Again, inspections are only required if they're elected on the contract, but if they are waived by the buyer, then you don't have to go through those additional tests. An FHA home does have to meet HUD guidelines, and like USDA, any chipped paint, missing handrails, exposed electrical would have to be addressed on the home before you could close on the property. Now, some of our lenders offer what is called FHA down payment assistance. Specifically, what this does is it can provide you with the funds for your down payment. And then if you can also acquire seller's assistance, then you could have a scenario like with USDA where you have to bring very little money to the closing table in order to purchase a home. One of our lenders does this with a minimum credit score of 620, and you can qualify either as a first-time home buyer or by meeting the income limits, being a retired employee, or being in a specifically exempt employment field, or having a property that's located in an underserved census tract. You can get, again, up to 3.5% in assistance for down payment, which can then be combined with seller's assistance if offered by the seller to significantly reduce the amount of funds you need to bring to closing. Where this program is offset is that it does have a higher interest rate than it would if you have a normal FHA purchase where you can bring the down payment out of your own pocket. I did learn recently after putting this presentation together that another lender of ours will do this FHA down payment assistance with a minimum credit score of 600. The rest of these would still apply generally to that lender as well. But these are some programs that I've talked about with buyers who don't have these savings for down payment and closing costs and who are struggling to put together those funds. This can also make it affordable for someone to buy a house if they don't qualify for USDA and they are struggling with the savings aspect. Finally, as far as loan programs, I would like to talk about the Veterans Affairs Program, which is also known as the VA loan. It was created in 1944 as part of the GI Bill of Rights, and it is intended for service members. For a VA loan, you must have veteran eligibility issued by the United States Armed Forces. Like the USDA loan program, there is no minimum down payment required for a VA loan. VA loans are also unique in that they have no private mortgage insurance, and that is because the Department of Veterans Affairs will guarantee the loan if it goes into default. VA has a minimum credit score of 500, but if you have a lower credit score, you likely will need some compensating factors. Maybe that means actually putting down a down payment or having significant savings. You can receive up to 6% in seller's assistance if offered for closing costs. VA also allows for the highest debt to income ratios of any of the major loan programs. And that is because they are looking at your residual income, which is a calculation that is done based on your current expenses and how much money you have left over for cost of living. The maximum loan amount is subject to entitlement calculation. So there's no set maximum of how much you can borrow with a VA loan. And then you can also use a VA loan repeatedly as long as you have entitlement available. It is possible to have two VA loans out at the same time. If you bought a primary residence and then you move to another location, you could use the VA loan potentially again if you have entitlement left over to do so. VA does require a pest inspection, and it also requires a water test if the water source is not public. VA can be used for a borrower and their spouse, but if you are not legally married, then for a borrower and a partner to use a VA loan, you would have to put a minimum 12.5% down payment. So what does that mean for you as a first-time home buyer? Well, you should be doing your homework. You should know what your credit score is and know what is on your credit history. If you don't currently have any kind of credit score, I would start by opening a secure credit card, which can be done usually through a bank or some other lending financial institutions. That card would help you to start building a credit score because it will build a pattern of showing that you are borrowing money and paying it back. You can also list any utilities such as your electric bill, your cable, your phone, your internet. You can list those utilities with the credit bureaus as self-reported utilities. And when you make those payments each month, those can also count towards generating a credit score and showing lenders that you are responsible at paying back money. You should also know what kind of assets you have available to use. What kind of funds do you have in the bank? Do you have any retirement assets? Do you have any investment assets? Because those can also be drawn on to use when purchasing a home. You'll want to know what your 2 years of job history looks like at minimum. You'll also need to know your 2 years of address history because these are all things that you'll be asked to provide on your mortgage application. And then you should know what you qualify for. You should know what loan programs are available to you as a buyer. So some next steps is that you should apply for a mortgage pre-approval. Here at CoLab Lending, we can do that with a soft credit pull. We can also, once we have that soft pull completed and we've reviewed your income and assets, we can provide you with a cost estimate. So you know how much you need for a down payment, closing costs, and what your projected monthly payment would be. We can compare FHA, conventional home ready or home possible, USDA, or VA programs to show you the pros and cons of each program for your specific situation and help you determine which program would be the best fit for your needs to purchase a home. Once you have that pre-approval in your hand, you'll be prepared to submit offers. You won't have to, when you see a house come on the market, go talk to a bank, talk to a lender, provide all that documentation and lose precious time. When you're pre-approved and you see a house come on the market, you can be first in line to put in your offer on that home. And when you're pre-approved, you also know your budget so that you can plan ahead. You know how much money you need in savings, and you can set that aside and keep that ready when you find the right house that you're ready to purchase. Now, why work with a mortgage broker? Here at Collab Lending, we are in fact a mortgage broker. So we work with a number of different lenders, which means we can shop around and find the best terms, services, or program for you as the borrower. If you're getting denied by other banks and lenders because of specific circumstances or situations, it's very possible that we can find a lender and program that would help you be qualified to purchase a home. Borrowers who worked with mortgage brokers saved on average about $9,000 in total costs over the life of the loan by working with a mortgage broker in 2021. I imagine all of us can think of ways we could spend $9,000, whether it's a vacation, in addition to the home, paying off a car. There's lots of things we could do with the money that is saved that you get by working with a mortgage broker. Experience is another reason to work with a mortgage broker. When I was talking with a realtor recently, she said, you know why I like mortgage brokers? Because you guys are good at problem solving. You're good at figuring out ways around guidelines and issues that other banks get stuck on. And that is true in my experience of where we've been able to come in and rescue deals that other lenders and banks haven't been able to close. Also, when you work with a mortgage broker, you have someone who is fighting for your financial interests. When you are working directly with a lender or a bank, you're working with the terms they're providing to you. But when you work with a mortgage broker, you have us in your corner of the boxing ring, so to speak, getting in and throwing punches if needed. That is metaphorically speaking, of course. But we can go in and we can push back against lenders when they ask for things that aren't needed. We can work to find you the best program and terms available, as opposed to offering you one set of things because you are stuck with one shop, as opposed to with a mortgage broker, you're working with many shops. Next, I'd like to briefly talk about what it means to buy a house. When I was speaking with a friend back in Texas, he actually told me that he doesn't know what all is involved in purchasing a house. So I thought it would be worthwhile to briefly share some of those steps so that you, as the first-time home buyer, are aware of the process. So the first thing I would say is to get pre-approved, to know what your lending options are. And once you have that pre-approval in hand, then we can connect you with a real estate agent. I will say that real estate agents are worth their weight in gold. They not only know the local market and can help find you a home that fits your needs, but they can also determine what the value of that home is going to be and help you put in a competitive offer that can help you to land that home when you find it. You'll also want to be researching home insurance, specifically who you want your home insurance to be with. Just as when you buy a car and you then put car insurance on the car while you're making payments, you also have home insurance that you buy, that you place on the home while you are making home insurance payments. Then once you are connected with a real estate agent, you can start looking at some houses, and then you can put offers in and say, I'll buy this house for $200,000 or $340,000. And then if the seller agrees to the offer that you provide them with, then you sign something called a sales agreement, which is a contract between you and the seller where you agree to buy a property for a specific price and to close by a specific time. Once you are under contract and you have that signed sales agreement between you and the seller, you can then have your loan application registered with a lender. That is then when your interest rate and terms are locked. And then you're given all of your initial disclosures, which we can typically send to borrowers electronically by email. Once you go through all of those disclosures and you sign something called your intent to proceed, we can then submit your application and your supporting documents like pay stubs, W-2s, bank statements, photocopies of IDs, personal taxes, to be reviewed by the lender along with your application. During this time of underwriting, your appraisal, title, and homeowner's insurance are ordered. Now, what is an appraisal? An appraisal is when a licensed agent will go out and will study the home that you're purchasing and determine what the value of that home is. He will study the interior and exterior of the home, and then he'll compare it to similar houses in that street, that neighborhood, that city that have sold recently, and what those houses sold for, to determine basically if you're getting a fair price for the house that you're purchasing. Now, what is title? Title, and I'd like to share this quote from a local title agency that we work with here. Real estate companies specialize in real estate, lenders specialize in mortgage loans, and title companies specialize in making sure that you get a free and clear title along with a smooth closing. The companies work to ensure people buy their homes with peace of mind, reduce their risks, and protect their property rights. So title and settlement companies will go through and they'll provide the correct taxes that are owed to city, county, and township, as is the case here in Pennsylvania. They'll also make sure who has the mortgage currently recorded, who owns the home at the courthouse. They'll handle all of the legal side of the transaction to make sure that when you purchase the home, no one has any loans or claims on the house that you're buying. And then, of course, the homeowner's insurance is requested at this time as well. And then during this underwriting phase, the lender will request any additional documents as needed until they are satisfied that they can then lend you the money that you are requesting. Then we get to the three words that every realtor loves to hear, and that is clear to close. This means that a lender is signing off on your application and is giving you the green light to purchase the home that you have put your offer in on. Closing can now officially be scheduled, and the final numbers needed for closing are balanced. Then you get to the day of closing, which is when you would bring your funds. Typically, buyers, if they put in an offer, they may put in something called a earnest money deposit or a good faith deposit. In some cases, that may be $1,000 to say, we're serious about buying this house and we're going to include $1,000 with our verbal offer. And then you would bring the rest of your funds for the house at closing, typically in the form of a certified check from your bank. You would do a final walkthrough of the home. You would sign all of your documents at the title/settlement agency. You would get the keys, and then you would get to celebrate. And so those are some of the steps involved with purchasing a home. And I just wanted to outline those again because not all of us typically go through the process of buying a home every single day or week, month, or year. And so I thought that would be worthwhile to share with some of you as first-time home buyers so that you have that understanding of some of the steps involved. Next, I would like to share my contact information here. You can see my name, Joshua Paik. You can see my email is josh@colablending.com. You can reach me directly at 814-326-1800. You can also see my NMLS ID there. I am licensed in the state of Pennsylvania and North Carolina. And then if you would like to start a mortgage application to see what you can get pre-qualified for as a first-time home buyer or as a regular home buyer, you can scan that QR code with your phone or smartphone device, and it will take you to our online application where you can begin providing that information, and then we can follow up with you from there. Next, I would like to go in and see just what questions you may have, and see if there's any in the chat box here. I don't see any in the chat box, and I don't see any in the question and answers. But if you do come across any questions, if you do come across anything you would like additional information out, you're welcome to reach out to me using that provided contact information, and I would be happy to speak with you further. So thank you for sitting down with me today. Thank you for your time, and I look forward to helping you become a homeowner in the near future. Thank you and have a good day.